Hello and welcome back. You tune into Markets at Noon, where we're taking you through the construct of the market and how should you be playing the market. And now to weigh in on that, we're now joined by Deepak Shenoy, founder of Capital Mind, who's joining us now. Hi, good afternoon, Deepak. Thank you so much for joining us today.
Thank you so much.
Deepak, so the consolidation that we're seeing in the market right now, is this a temporary pause before we start moving higher? Because if you look at the macros look very ripe for Indian market. The rate cut has come through, the dollar index is cooling off, and with the hope of the earnings improving going ahead in the second half, perhaps. Do you see the markets go higher from here on after a phase of consolidation? And do you see this? When do you see this consolidative phase getting over?
So, we're fund managers, so we always like the markets to be going up. So always, we'll have this optimistic view that in general, the markets should go up, but it's very difficult to predict the short term. So we're not really keen on saying, oh, no, it's going to happen 3 months and 6 months and all that. But in general, I think there's a lot of uncertainty in the near term. That near term uncertainty causes markets to be both volatile upside and downside. I think not much point predicting or trying to do anything about that. If you look at the longer term sentiment around, 2 years, 5 years, 10 years, I think those are a little more understandable from the perspective of the macro. The macro says that India is relatively less leveraged. The government does not have as much debt to GDP as otherwise. Our interest rates are much more controllable because inflation is low. We have corporate capex that is probably has a lot of room for it to grow because corporate balance sheets are strong. Domestic consumption in terms of retail loans hasn't picked up meaningfully in the last year or so, and I hope that will change. But by and large, those have been the breaking down factors, saying we're not growing meaningfully largely right now. But I think longer term we'll do well. Whether this phase is a consolidation phase or a before a breakout or whether it is before a breakdown, I'm not sure. But my feeling is if you're in this for the long term, that India is a great place to invest. We have a strong economy, relatively better than perhaps a lot of other countries around the globe. The markets may reward some other pockets, basically because they've either been beaten down too much or have a temporary upsurge. But in relatively speaking, we are expensive, but we're also growing. So we're paying for long-term growth. And I think if you're in this market, you shouldn't think of the next 3 or 6 months as your target territory. You're thinking of 5 years. I think then you have a better chance at making a reasonable return.
Good afternoon. This is Shrishti joining in. But Deepak, we can definitely understand your optimism towards the market, that being a fund manager, you are always optimistic and you want the markets to go up. But the fact of the matter is that there is a rise in the geopolitical tensions and that's impacting crude, which is not good for the Indian market. So give us some sense that how do you see the crude movement? Do you believe that such elevated levels are sustainable, or do you believe that there could be a cool off anytime soon in the crude oil prices? And vis-a-vis that, maybe it's a good time to look out for some OMCs, which are any which ways cheaper.
So OMC have always been cheap. For one, they're cheap for a reason, is because they don't have any pricing power meaningfully. The last few years have been good for them because they've been able to buy crude at whatever price, and their retail prices to you and me have been the same more or less for the last 3 years. So we've had no real meaningful inflation or deflation in the fuel prices at the pump for 3 years now. The crude itself was at $140 in 2008. So it's at $70 now, half that price. We're talking of an increase from some 60 odd dollars to some 70 odd dollars, which is again not meaningful. I think from a perspective of whether India can handle this, I think it's fine. We're okay with everything. What will happen is margins will change for even for the OMCs. I think the overall margins from the refining end crimp down a little bit. They get expanded margins or contracted margins on the retail front. So they're very volatile from that perspective, and nobody values them meaningfully. So the problem really is that you have great ROEs when at certain times, but terrible ROEs at times when you can't control the prices and the government wants you to take the hit rather than reducing excise duties when crude prices go up. So I would not meaningfully try to bet long term on any of these stocks right now, other than short term momentum bursts if you are more a technical person. But I don't meaningfully see this as a long term kind of growth oriented strategy. However, I mean, crude prices, as I said, their absolute levels are not meaningfully high, and most Indian inflation that is imported from the crude basket is slowly starting to change also, because our mix of vehicles is starting to change. Our domestic crude prices, petrol and diesel prices are more or less stable. We've had, even with geopolitical tension, I think we have not had any meaningful change in input prices for a lot of raw materials that are based on crude as well. So I don't see this as a huge thing. Of course, the prices go beyond 100, 120, then we
Right.
have bigger problems.
Right, Deepak, thank you so much. Point taken. With that, we will let you go on that note. It is time for us for a quick breather. We'll be back with more market updates on the other side. Stay tuned.